Be Wealthy and Smart, episode 1059.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the price of oil dropping below $100 a barrel. This is big news because oil is directly part of the problem of this high inflation we've been seeing. And lower oil prices means that inflation is coming down. And we're seeing that reflected in the bond market. The bond market last week was down 0.22% in interest rates, which is a great sign because earlier in the year, interest rates were rising as inflation was rising and as we were expecting the Fed to have to raise interest rates. So interest rates were rising ahead of that, and now we're seeing interest rates start to drop. Could this mean that peak inflation is behind us? It could, but we have to see other signs of this as well. And there are some signs out there. Besides oil prices being down more than 7% from their highs and interest rates declining, we also have some commodity prices declining. I've been reporting to you about lumber prices dropping dramatically and copper prices, which is great for home builders. Commodities such as cotton have shed more than a third of their price since early May. We also see gas prices in the U.S. now having fallen for 21 days in a row after lurching upward during the early invasion and the war. A broad index of commodities maintained by Bloomberg was down as much as 4.5% yesterday. Falling commodity prices are a sign of fears about the economy because they reflect expectations that fewer materials will be needed for production and transportation. According to the Washington Examiner, the dip in commodities is one of a string of signs that inflation may be peaking. It goes on to say core inflation fell for a third straight month in May, the Bureau of Economic Analysis reported Friday in its update to the Personal Consumption Expenditure Price Index. Core inflation strips out the prices of food and energy, which are highly volatile and is seen by economists as a more reliable indication of the direction of prices. So those are the kinds of early signs that we look for. Those are the hints that we get before we get the CPI number. And we will get the CPI number next week, and that will tell us how inflation has been running. But that is a backward-looking indicator. And to find out where things are going, you have to look at forward-looking indicators or at current prices and current interest rate trends. And that's exactly what I'm reporting to you. So those things, when we look at the dip in commodity prices, when we look at oil prices coming down, when we look at commodities prices coming down, we look at interest rates coming down, these are all indicators that tell us ahead of time that inflation may have already peaked. Now, along with this, Europe is having a more severe reaction than we are here in the U.S. And recession in Europe is definitely possible due to a lack of oil and gas supplies. You see, they were buying a lot from Russia and they're not able to replace that very easily. So they're literally running out of oil and gas. And that has caused the euro to decline in value about 9% against the US dollar since the beginning of the year. And the US dollar and the euro are almost 1-to-1 equal, which hasn't happened in 20 years. The last time we saw this was in 2002. So while the media is pushing the recession narrative very strongly, we're seeing signs of weakening that could be a recession, but may not be a recession. That remains to be seen. The dollar has been stronger, and that goes against all of the people that have said that the dollar was going to fall out of bed. We've actually seen it gain strength. And that's what caused metals and mining stocks to drop sharply yesterday, was the strength of the dollar. So yesterday, the stock market opened about 2% lower across the board, but then NASDAQ climbed 1.75% and ended up in the green, and the S&P rose 0.16% after being down more than 2% at the session lows. And the Dow Jones ended down 129 points after being down more than 700 points earlier in the session. So basically, I think there was a lot of pent-up selling that came in the markets Tuesday morning, and then institutions and retail investors started buying the dip. And that started to make the market recover as we saw prices come down, especially oil prices come down below $100 a barrel. People started buying. We saw a lot of short covering, and one of the bellwether companies to look at is Cathie Wood's ARK ETFs, and when they go up 8% in a day, you can be sure there's some short covering happening there. But also, the technology stocks really got a bid because with interest rates down 0.22% in the last week, lower interest rates will help boost growth-oriented tech stocks. And it's leading to early speculation that maybe we might see the Fed pivot if peak inflation is in fact behind us. Now, this is not the popular opinion with the media, but we have to look at the indicators that are forward-looking and in the present time and forward. And the August contracts for oil are what dropped below $100 a barrel to 99. So that forward-looking indicator is telling us the price of oil is coming down. It's responding to the weakness in the economy. Things are slowing, but yet we're not seeing massive, huge layoffs, which is what you normally see during a recession. Yes, we've had them in the mortgage area because refis definitely slowed down to almost nothing, and home purchases definitely slowed down. However, we're not seeing layoffs all across the board. In fact, we're still seeing a tight labor market. So that strong labor market is really good news for the economy because that is 70% of the economy is the consumer and their ability to spend. In order to spend, they have to have a job, and as long as they're employed, that's good news. So we're seeing these little green shoots, we're seeing little early indications that possibly peak inflation might be behind us, possibly peak interest rates might be behind us, possibly we might not have a recession. We've seen little green shoots of all of that. Now, I can't say for sure, but it could also mean that the low of the stock market is also behind us, which nobody wants to talk about. So we'll continue to monitor the situation and report into you on more signs of which direction things are moving. But as long as things are getting better and improving, the stock market will take that lead. And it looks 6 months ahead. So it's looking forward. It's not looking at the past numbers. And if it sees lower interest rates coming, which the bond market is predicting, if it sees lower commodity prices, if it sees lower oil prices in particular, these are all positive things that are going to help the stock market recover more quickly. And it's important to remember that some of the news that we're going to get with indicators, again, are rear view mirror looking. They've already happened. They're already in the past. What we want to do is keep our eyes looking forward to see what's coming next. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And don't forget, all of my podcasts are available on my website at lindapjones.com/podcasts, where you can also sign up for my weekly newsletter with more market insights and financial tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.